President, I want to speak briefly here on the bill that is before us and how I think it can be improved. First, I want to congratulate the chairman of the committee, working with the ranking member. I understand they've reached an agreement on how to do the issue of resolution, which addresses the issue of too big to fail, which is a very critical part of this bill. And I congratulate them for making that type of an initiative, and I hope that the rumors are true and that such an amendment that will address a strong too big to fail language so that American taxpayers will not be on the hook for institutions which overextend themselves and take on too much risk, but are institutions that are so large that it is felt that they are too big to fail, that concept will no longer be part of our lexicon, and we will essentially put an end to it. So I congratulate the chairman on that and the ranking member. There are, however, other major issues within this bill that need to be addressed, and they're extraordinarily substantive and rather complex. A few of the ones that aren't even in the bill, for example, is how we address Fannie Mae and Freddie Mac. We know that the American taxpayer today is on the hook for somewhere between $400 and $500 billion. $400 to $500 billion that we're going to have to underwrite in order to stabilize those two entities on the debts which they have run up, or the credits which they have run up, which have gone bad, and they have purchased. And that's serious. There will be a proposal that comes forward from our side of the aisle. It won't totally restructure Fannie and Freddie. It should. I'd like to see that. It's too complex to do in this bill, but it will at least address some of the core issues that need to be addressed. For example, we ought to tell the American people upright and forthrightly how much they owe. It ought to be on budget. We ought to put on budget what the obligations are, because they're very scorable relative to the cost that the American taxpayer is going to have to bear in order to bail out and maintain Fannie and Freddie. And it's going to be somewhere around $400 to $500 billion of additional debt. And we know it's coming, and we ought to talk about it, because it affects other debt obligations of our country in a lot of different ways, but primarily through crowding out. Secondly, the bill has language on underwriting, but it's really not strong enough. If you want to look at what caused this event back in the end of 2008, what caused this traumatic event which almost brought the entire financial system of America down, which almost put us into a depression, put us into a very severe recession, cost a lot of people their jobs, and there are still a lot of people experiencing trauma as a result of it. There are 3 or 4 main causes. I've talked about them before. One, of course, I believe, was that the money was made too easy to get at too low a price for too long by the Fed. Another was the fact that the Congress specifically encouraged and, in fact, forced lenders, for all intents and purposes, to lend to people who couldn't afford the homes that they were buying, because it became congressional policy to do that. Another was that people were shopping for the weakest regulators. This is what happened in the derivatives market. And the derivatives were not structured in a way that actually put capital or liquidity or margin behind derivatives. And the fourth, and I think it was probably the most significant, was that there was a total breakdown in underwriting standards. In other words, the people who were making the loans on subprime mortgages and on other types of exotic instruments so that people could buy houses who couldn't afford them were making those loans and not looking at the underlying value of the asset, and they weren't looking at the ability of the person to pay back that loan. What they were doing, quite simply, was making the loan because they were going to get a fee for it, and then they were going to sell the loan, securitize it. It was going to be chopped up and sent out and syndicated, and they didn't really care what the loan did, because they basically were just making a loan for the purposes of getting a fee. And in the banking industry, those were the one-off lenders, but in the banking industry, you had a complete breakdown. Banks were lending to people who they knew couldn't repay it when these loans reset, and they knew that the value of the asset could only support that loan if there was appreciation in the markets, which was a gamble. This happens every time we go through one of these events, by the way, one of these real estate-driven recessionary events. It happened in the late 70s. It happened in the late 80s when I was governor of New Hampshire, and New England went through a horrific contraction as a result of an expansive effort of lending money in the real estate markets. underwriting standards break down. There needs to be a clear national definition of what proper underwriting standards are. And Senator Isaacson and I and a number of other people, Senator Corker, are going to put forward an amendment in that area. But one of the core areas here that needs to be addressed, and hopefully it will be included in this bill, and improve the bill in this area. But one area of this bill that simply has to be changed if it's going to be effective in doing what it's supposed to do is the area and the language in the area of derivatives, the language of derivatives. Now, most Americans don't understand derivatives. It's understandable. They're complex products. But basically, try to think of it this way. If you're on Main Street and you've got a business, usually a fairly large business, and you're making a product, you want to be able to sell that product to somebody at the price you quote that person and make the profit that you expect at that quoted price. But there are a lot of things that affect that product that you can't control. If you're selling it to another country, you can't control what the dollar is going to do in relationship to the currency of that country. For example, if you're selling it to Brazil, for whether their currency is going to go up or down vis-a-vis the dollar. If you make the product today, you enter into a contract to sell it today, but you can't deliver it for 6 months, your whole profit could be wiped out by the dollar devaluing relative to that currency. Or the materials which you buy to make that product may change in value or availability. Or the person you're getting a loan from to subsidize you, not subsidize you, but to allow you to expand your businesses to build that product, that person who's giving you that loan may have financial troubles and may not, and you may have an issue there, or vice versa. You may have an issue with that person. All of this are things which are usually beyond the ability of the individual who's making the product, in this case I'm talking about making products, to control. So there's something called a derivative, which is an insurance item. Basically, someone insures for you over those risks. And there's a lot of complexity to this because these insurance items mutate into all sorts of different instruments. They can affect financial instruments, they can affect commodities, they can affect goods, they can affect just plain currencies. But they are critical instruments, derivatives, for making the economic engine work. They're sort of the grease you put in the economic engine to make sure it doesn't seize up, to allow the economic engine to move down the road. They're so critical, in fact, that they're approximately $600 trillion of notional value. Now, notional value really is just it's not what the risk is because there are underlying assets here, but that's a big number, big number. And so we have to make sure that when we amend the derivative section of this bill to try to make them have a stronger derivatives industry, we don't make big mistakes and basically undermine the ability of people to use this type of instrument to get credit and to make the markets work and to create jobs on Main Street, because these all tie back to jobs on Main Street. You know, even if you're not working for the company that uses the derivatives, you're probably working for somebody who does business with the company who does derivatives. In Nashua, New Hampshire, there are a bunch of big companies that do derivatives. There are a lot more smaller companies that sell products to those companies on Main Street. And so it will affect Main Street if we do this wrong, because credit will contract. And in America, the unique advantage America has is that we're the place in the world where if you've got a good idea and you're willing to take a risk yourself and you're an entrepreneur, you can usually get capital and credit to allow you to do that idea, take that risk, and thus create jobs, which is the bottom line for all of this. We want to create jobs. So derivatives play a large role in making that system work. Well, this bill, unfortunately, adopted language which was put forward in the Agriculture Committee, which really literally undermines, first, the safety and soundness of the derivatives market, and secondly, the ability of America to be the leader in the derivatives market. Now, our goal here should be very simple. Our goal should be two steps. One, make our banking and financial system safer, sounder, and a system which will, to the extent we can anticipate it, avoid systemic risks. And second goal, in doing that, while doing that, our goal must be to have a vibrant credit market and capital market and be the primary place in the world where people come to create credit and capital, because that gives us a competitive advantage over the rest of the world. That creates jobs here in the United States. Well, unfortunately, this bill, as structured, doesn't accomplish that. In fact, it undermines that. A good derivatives reform bill would essentially create an atmosphere where derivatives are more transparent, where the pricing is more transparent, and where there is standing behind the two parties to an agreement on a derivatives contract, assets, liquidity, margin, something that can be turned to should one of the parties fail to perform on the contract. This can be done by creating a reasonable exception for end-use derivatives. Those are ones where you basically have a pure commercial purpose. And if people don't fall into that reasonable exception, then requiring, essentially, that all the other derivatives be cleared and go through what's called a clearinghouse. And the clearinghouse becomes basically the situation where the two parties to the contract, or multiple parties to the contract, essentially put up collateral, margin, liquidity, so that the contracts are supported, the counterparties are supported. And the clearinghouse also itself has to be collateralized adequately, capitalized adequately, so that it doesn't become a risk, because it's going to be the insurer, basically, of these contracts. All very doable through a new regulatory restructure or a modified regulatory restructure. And then, as these contracts become more standardized or are standardized, they move over to an exchange. And a lot of them could do that right now, but some of them simply can't, because the exchanges, the contracts are too customized to move directly to an exchange. But over time, most of them probably will, and that's the way it should be structured. Unfortunately, in this bill, it is directed that we set up a new process for doing these derivatives by taking the basically market makers in these derivatives, which are the swap desks, and moving them out of the financial institutions into separate institutions. Where this idea came from is hard to fathom, because on the face it makes absolutely no sense. I mean, it is so counterproductive to the purpose of making the derivatives market safer, sounder, and more efficient, and as a result, a better market, which creates credit in a transparent, fair, and effective and sound way. It is so counterproductive to that on its face that you would have thought that anybody who suggested this would have immediately been pointed out that this doesn't work. But for some reason, it's found its way into this bill. And the practical effect of doing this is that you're going to create these separate entities. These separate entities are going to have to be capitalized, because you've got to have capital behind these derivatives desks. That's the whole point. You've got to have something standing behind these desks to make them viable so that you don't end up with an AIG. What was the AIG problem? There was nothing behind the derivative contracts except for the name AIG. You don't want that again. You want capital. It is estimated it would cost $250 billion to set up these separate desks. What does that mean? That means that capital is not going to be available for credit, for the creation of credit. You're going to see an immediate contraction. It's estimated by the industry, and again, this is an industry number, not mine, so you can take it with a grain of salt, that will cause a $750 billion contraction in credit. That's Main Street. Main Street not being able to get credit. Even give them credit, even say they've exaggerated and say that it's only going to contract 80% of that, still $600 to $700 billion of credit that's not available on Main Street to do business, to create jobs, to take risks. It's just foolish to do that type of a contraction and to set up this structure. Plus, you've got nobody that's going to oversight this as effectively as the people who oversight the present derivative market makers. The FDIC won't be able to get on top of this. Fed probably will have trouble getting on top of this. You're going to create an actually less stable platform from which to do these markets when your whole purpose of this bill was to make it more stable. Makes absolutely no sense. This was Section 106 in the Ag Bill. I think it's Section 714 or something in this bill. And you don't have to believe me on this. I mean, two of the major premier regulatory agencies, which have no real, which are the fair arbiters here, really. I mean, they're the umpires, have both come out in a very unusual way, because they don't usually comment in the middle of a legislative process like this, and said this is really, my paraphrasing, a stupid idea, a counterproductive idea, the type of idea which if it were to be put in place would be cutting off your nose to spite your face and would end up with a less sound system. Let me read to you from the commentary from the Federal Reserve staff on Section 106, which is now, I believe, Section 714. Here's what the Federal Reserve staff said about this approach. Section 106 would impair financial stability and strong prudential regulation of derivatives, would have a serious consequences for the competitiveness of the United States financial institutions, and would be highly disruptive and costly, both for banks and for their customers. I mean, that's pretty specific. That's pretty damning testimony as to the effect of this language. It's going to reduce our competitiveness because a lot of these derivatives will go overseas. It's going to make it much more difficult to have sound regulatory policy towards derivatives. And it will be highly disruptive and costly, not only for the banks, but for their customers. That's called Main Street, the people who create the jobs. A really inappropriate idea that's been put in this bill. But don't just rely on the Fed. If you're a Fed hater, and there appear to be a number of them in this body, for reasons which I'm still having trouble fathoming, must be something against having a sound money policy. But if you don't like the Fed, listen to the FDIC. Now, I don't think anybody around here doesn't give great credibility for the way that Sheila Bair handled, the chairman of the FDIC, handled the bank crisis. I mean, very honestly, they stepped in, they settled out a lot of major banks. They did it in a way that was extraordinarily professional, and as a result, the markets remained calm. People got their money back. Deposits were not at risk. This is an agency which has high credibility. And this is what Sheila Bair's Chairman Bair has specifically said about this. If all derivatives market-making activities were moved outside the bank holding companies, most of the activities would no doubt continue, but in less regulated and more highly leveraged venues. In other words, be much, much more risky. Such affiliates would have to rely on less stable sources of liquidity, which, as we saw during the past crisis, would be destabilizing to the banking organizations in times of financial distress, which in turn would put additional pressure on the insured banks to provide stability. In other words, bad idea. It undermines the banking industry to do it this way. And finally, thus, one unintended, actually this isn't finally, the whole letter is 3 pages long and has a lot of very strong points in it, but final point I'm going to read. Thus, one unintended outcome of this provision would be weakened, not strengthened, protection of the insured bank and the deposit insurance fund, which I know is not the result any of us want. That's pretty specific. So you've got the Fed on one side, one of the major regulators saying this idea doesn't work. It'll undermine the structure of the banking industry. You got the FDIC on the other side saying this proposal doesn't work. It's going to undermine the insurance deposit system. So you don't have to listen to myself or others who pointed out the failure of this section. Listen to these regulators. This section has to be removed from this bill. There are other things that need to be done in the derivatives area, which would improve the language. For example, you should not be mandated, once you're on a clearinghouse, you should not be mandated to go directly to an exchange because it simply won't work. There needs to be an intermediary step as standardization, and then the best thing to do would be to require regulators to look at these different instruments, and if they feel they can be standardized, tell the people that are producing them to be standardized and then move them over. But to just unilaterally say everything's got to go to an exchange is, I think, going to be counterproductive. And again, push a lot of business offshore. But clearly, this one section is really damaging to our efforts to produce a safer, sounder, more transparent derivatives regime which has adequate liquidity and capital behind it and which keeps America as the primary place to do credit in the world so that our entrepreneurs can get credit at a reasonable price so that they can go out and take the risks to create the jobs in America. Mr. President, I ask unanimous consent to enter both these statements in the record.
Without objection.